In this video, we talk about financial health evaluation. In a paper published in 1967, a finance professor at New York University, namely Edward Artman, developed the Artman Z-score formula. He used the multiple linear discriminant in his analysis, and later in 2012 he released the updated version that is called the Artman Z-score Plus to evaluate both public and private companies, both manufacturing and non-manufacturing companies, and both US and non-US companies. Altman uses the financial statement data 1 year prior to bankruptcy to develop the 5-variable model. In the model, X1 is the total current assets less the total current liabilities divided by the total assets. H2 is retained earning divided by the total assets. H3 is earning before interest and taxes divided by the total assets. H4 is the market value equity divided by the book value of liabilities. And H5 is the revenue divided by the total assets. For public held companies, data in the balance sheet, income statement, cash flow statements is available on yahoo.com. Taking Microsoft as an example, the balance sheet and the income statement can be obtained via the links. And here we notice that the symbol on the link is the stock symbol for Microsoft, and also annual as the second keyword to the link. And from the balance sheet, we can get the total assets, total current assets, total current liability, retained earnings, pre-tax income, interest expense, revenue, market capitalization, and total liabilities. From there, we can calculate the predictor variables H1, H2, H3, H4, and H5. Plug the predictor variables from H1 to H5 into the formula. We can get the Z-score for Microsoft, which is 4.44, indicating that it is in the safe zones. The Z-score below 1.8 means the company is likely going bankruptcy. Z-score above 3 means the company is unlikely going bankruptcy and it is in a good shape. For scores between 1.8 and 3, it is a gray area in which the company financial health is uncertain. The model was accurate in classifying 95% of the total sample correctly 1 year prior to failure. Misclassification of companies that were going bankruptcy increased as the prediction time increased. If the prediction time is 2 years, then misclassification rate is about 28%. And later it increases to 52% for prediction time of 3 years and 71% at 4 years. Z-score is very useful for investors, and they can use Z-score to determine whether they should buy or sell. Now let's look at the predictors for more details. The first predictor is working capital to total assets. The working capital is a company's current assets less the current liabilities. Working capital measures a company's efficiency and short-term financial health. Positive working capital means that the company is able to meet its short-term obligations. And negative working capital means that a company's current assets cannot meet its short-term liabilities, so could have problems paying back creditors in the short term.